From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, inflation fears are rising. Consumer expectations for long-term inflation are at their highest level in 30 years. The data sending stocks sliding and Treasury yields hitting 2-week lows. And Treasury Secretary Scott Bessent says the U.S. is a long way from boosting longer-term debt sales. But we're going to begin with the big issue, Treasury yields stuck in limbo.
10-year Treasury yields are kind of stuck between a rock and a hard place.
We haven't seen bond yields come down all that much, and that really looks mispriced.
The economy is still in expansion. Corporate earnings have adjusted, and they're moving higher. And the 10-year Treasury, which looks at all of this stuff, is still relatively stable.
Growth expectations are very high in the U.S. at the moment.
What the bond market is ultimately going to be trading off of in the long end is what that growth impulse is.
It's going to be a while before the crowd that wants to see lower rates from the Fed it gets any kind of pleasure.
We do think we reassess and rates slowly drift lower over the course of the year.
That's what you've seen, is that yields have been in limbo, kind of pegged to 4.5.
The 10-year a little bit too high right now. I'd be shooting sub 4%, closer to 3.5.
The conviction level on a scale of 1 to 10 is about a -2. Nobody has any clue as to what's coming next.
Let's look at the consumer inflation expectations, because they're at their highest level since 1995. What's fascinating about this move is that it's driven yields on the longer end of the curve lower. And you would think that higher inflation would mean higher yields. But if you have a weaker consumer, then you have another question about what it means if the consumer is not willing to spend to prop up the economy. Let's take a look at the term premium as well that exists on the 10-year note, because it's at the highest levels really since 2023. It's come down just a little bit. You have the Treasury Secretary that has been watching this come down and happy about it. But as you can see, it's quite elevated still relative to recent history. And this is showing you the cost that investors are expecting when it comes to buying into the 10-year. And the higher this is, the more expensive. You have got higher government borrowing costs in the future. The question is, does that remain elevated? Speaking of the term premium, we were saying that Treasury Secretary Scott Bessent, who just joined Bloomberg Surveillance yesterday, this is how he is watching it on his radar.
I thought that the rate cut in September, that it was oversized. The market responded, but now we're seeing term premium come back down. So we'll see what happens from here. The 10 years come down, or rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great.
Joining us now, Brian Rehling, head of global fixed income strategy at Wells Fargo Investment Institute, and Jonathan Duensing, head of U.S. fixed income at Amundi U.S. And let's start with you, Brian, on where you think the 10-year is going to go. If the Treasury Secretary is watching it every day and there is a spread that is really significant from investors, is it higher or lower at the end of the year, and how much?
I mean, our expectation is for rates to move higher. We have a pretty positive outlook on growth, and also expecting inflation to tick a little bit higher by the end of the year. So we see the rates higher. Our target for the 10 years around 4.75 by year end, 4.5 to 5%, and really on positive things going on in the economy, going to push those rates higher in our expectation.
Where do you feel that this will land at the end of the day, Jonathan? Do you stand in that category, or are you in the yields-driven lower camp from now?
Well, I think if you look at, especially the longer end of the yield curve, the 10-year is a reasonable place to land on the conversation we're having. But if you just think about the drivers of where those yields tend to be over a longer period of time, it's highly correlated with nominal growth in the U.S. So if we're in an environment of 2% real growth and 2.5-ish type of inflation, 4.5% area on the 10-year right now does not seem that unreasonable to us. So going forward, we're either going to need to see a big change as it relates to either the growth trajectory or the inflation trajectory to see significant deviation as it relates to where we are right now in the market.
Well, let's talk about growth for a second. Brian, what role do consumers play in the growth story? If you have so many in the University of Michigan survey worried about longer-term inflation, are they going to be adding to the growth story?
Yeah, I mean, obviously here in the U.S., consumers a massive part of the story. And, you know, if consumers feel good about their personal finances, which generally relate back to their employment situation, how comfortable they are in their job, their likelihood of being able to go out and find another job, feel comfortable there, they're willing to spend and continue to kind of push growth higher. Good news for the economy. It's when you get some of the shocks and you start seeing people concerned about their personal situation, especially as it comes to employment, that you start to see a real pullback in the economy. And we just don't see that right now.
Do you think that there are growth risks out there? And do they, Jonathan, come more from the consumer end of things or from the government side of things? When you see government spending being reined in, there was a sense that for years now, stimulus has been holding up the economy in significant ways. Does that drag down the growth story?
Well, there's no doubt that, you know, as you said, stimulus from the government has been a big part of the last couple of years of, you know, maybe surprising growth or the persistence of growth here in the U.S. As you know, as many were calling for a recession. I think also it's just been the positive dynamics around immigration. So I think if you look in the near term here, you know, as immigration has already started to slow net into the United States, you know, that is going to have somewhat of an impact as it relates to overall consumption and then productivity measures. And then if you think a little bit longer term, you know, we still need to wait to ultimately see, you know, what the impact is going to be of the eventual fiscal plan that the Trump administration is able to put in place. So until we get to that point, which we still believe is the second half of this year, when you really get, you know, some more meaningful legislation on that front, it's really going to come down to, as Brian had mentioned, you know, how do consumers feel? How do businesses feel as it relates to maybe some of the uncertainty that's emanating right now from Washington, D.C.? I mean, you're certainly seeing, you know, that dynamic play out when you're looking at activity surveys, confidence surveys, where there was initially this post-election bump across all fronts there. But now we're starting to get more recent readings where, you know, you're seeing consumers as well as even businesses start to show a little bit less confidence than they had post the election, as I think just some of the flurry of activity that's going on in D.C. right now has created a level of uncertainty that is maybe, you know, somewhat slowing down business activity. I don't want to say paralyzing, but it's certainly having an impact on maybe the decisions that consumers as well as businesses are making right now.
Brian, what do you make of the decisions being made in Washington when we think about the couple of weeks ahead of us and the conversations that are starting to stir around the budget, about the debt ceiling, this idea that there could be a $4 trillion increase, and that uncertainty around an X date, the deadline really for the Treasury Department to figure out how it can pay its bills? Do you think that's going to create more volatility in this bond market in the following months?
Yeah, I do think we'll get off of this kind of 4.5% level in terms of volatility moving one way or the other. I tend to agree. There's a lot of uncertainty out there right now. And, you know, markets, quite frankly, have digested this uncertainty pretty well. And as over time we get certainty, you know, markets like certainty. You know, consumers, businesses like certainty. So as this uncertainty turns to certainty, however it turns, I think will generally be a positive for markets, for the economy. But yes, there's a lot of uncertainty. I do expect a fair amount of volatility. Markets have, in many ways, already become, I don't want to say immune, but they've become desensitized to a lot of the rhetoric out there, right? You get some significant rhetoric in terms of tariffs and different things. And, you know, early on you saw big moves. You see less of that now. But I think the next key is really to see how a lot of this turns into actual action, how it turns into certainty. And in general, I think that will be a positive thing for markets.
You know, notwithstanding any potential future near-term volatility, you think about the Treasury Secretary's argument here for lower yields ahead in the face of most investors, many investors thinking higher for longer, reining in the budget deficit, having non-inflationary growth, bringing down energy prices are a big part of that story. Jonathan, do you buy what the Treasury Secretary is putting down?
Well, I go back to the comment that I made earlier, and it just as it relates to, let's think about potential growth of the U.S. economy, which we still see in the 2% area, and how do we think about the path of inflation here over the near intermediate term. I think the movement that we've seen in Treasury yields over the course of the last 3-4 weeks or so has really been tied to maybe just investors adjusting some of their expectations as it relates to what the near-term growth trajectory really could look like for the U.S. There's certainly a lot of optimism coming out of the election around what potential growth could look like. But now, given some of the uncertainty as it relates to ultimately what policies will be implemented, it's understandable that investors have maybe ratcheted back some of those expectations on the growth side. And it touches at the point that you had made earlier at the opening of your show, which was, we've seen maybe some inflation expectations moving higher, but at the same time, yields have moved lower. Notably, we've seen real yields moving lower, which is more a reflection of how investors are thinking about the growth trajectory of the U.S. economy.
Real yield is certainly the name of the game. It is also the name of our show. We thank you both for joining us on it. Brian Rehling of Wells Fargo Investment Institute and Jonathan Duensing of Amundi US. And up next, the auction block, because it's been a busy week for debt deals. And that included a relatively newer entrant to this market, Michael Saylor's company Strategy, with the sale of convertible debt, which will help it buy even more Bitcoin. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we had a good pace of global debt sales this week. We're going to start in Europe. Its primary market year-to-date volume reaching 500 billion euro, the mark in the shortest time ever. U.S. companies Kraft Heinz, Boston Scientific among the sellers this week, as the trend of the so-called reverse Yankee deals continue to grow. And here in the U.S., high-grade weekly volumes of more than $52 billion easily outpaced dealer expectations. Notable names included HCA, J&J, Cisco, and Barclays. And two high-profile offerings from the U.S. Treasury this week. We had a 20-year sale which had a slight tail, and the 30-year tip sale, which had the highest yield since 2001. We're going to be speaking a lot more about issuance this year, I guarantee you. And speaking of Treasury issuance, Secretary Scott Bessent on Bloomberg Surveillance affirmed his goal to boost the share of longer-term securities, but that will be a long ways away.
That's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
Joining us now to talk about corporate credit, Ashley Allen, Global Credit Strategist at JPMorgan Private Bank, and Winnie Cisar, Global Head of Credit Strategy at Creditsights. Winnie, I feel like every time I talk to you, it lately has been about the love of the market for risk in the bond market, as though nothing is going to go wrong. Is that warranted?
We think no. We think that there's a lot of optimism that's still priced in to credit spreads, especially, and not enough of the caution. And we are seeing economic data come in consistent with our expectation for a little bit stickier inflation with a decelerating consumer, and perhaps not enough momentum on the manufacturing side of things to really offset that and continue to drive GDP growth at or above trend. And when we think about how that extrapolates to corporate credit, that does lead to some potential margin pressure, perhaps leverage points going a little bit higher, interest coverage coming down. And when we look at historically tight spreads, really in all pockets of the credit markets, it doesn't make a lot of sense to us.
What do you think, Ashley, about the potential here for gains? You can understand the risk under the market, but you could also kind of understand here why investors are looking at high yield and even leverage loans to the degree they are, with stock market valuations where they are. Of course, this is a hunt for returns. What's the good, the bad, and the ugly?
That's right. So I want to first acknowledge I would generally agree with Winnie's sentiment that spreads are at all-time tights. And investors should probably exercise caution with choosing where they want to be in the fixed income markets. What I would say is that yields do look attractive, though. So on a historical basis, when you look in the sub-asset classes, whether it's investment grade or high yield, yields are kind of at 15-year post-GFC highs. It's pretty compelling. In both markets, you can get mid-single-digit plus returns from carry. That's where we think investors are going to get value in fixed income through 2025, that carry component. So I would say fixed income is attractive in the sense it's a diversifier within an asset class, or with compared to other asset classes, investors still should have it in their portfolios. But I would exercise caution in picking where they want to be to take advantage of those tight, to take advantage of the high yields in spite of the tight spreads that we do see.
What do you think, Winnie, of kind of the lessons to be had here for investors as they enter into the type of risk appetite you're seeing? To the event, you would advise people to avoid pockets that could enter distress, and there has been some of it. I've been pointing out bankruptcies or restructurings to my team as often as I can. They're certainly there. What would you advise to avoid?
So I would say that we are looking to avoid anything that is going to have an outsized kind of surprise hit from potential policy changes or just shifting global macroeconomic trends. So when we look at sectors like Basak that are very globally exposed and have also performed quite well, we're a little bit cautious there. Similarly, when we look at retail valuations, especially in investment grade, they're objectively very tight. And while most of those issuers are higher quality and tight spreads are somewhat warranted, we do have some concerns that continued consumer trends that are shifting, and then also layering on tariffs or immigration policy, the laundry list of worries are probably not going to be particularly helpful for retail issuers. So avoiding those sectors that are kind of front and center for potential impact from economic and policy changes, and trying to align with that higher quality carry where we see opportunity still in some of the bigger U.S. banks makes a lot of sense to us.
Ashley, one thing that's been really fascinating me lately is you look at the flows, particularly to retail products, ETFs tied to high yields, investment grade, and even CLOs. There's been a lot of interest and a lot of fluctuation. What are they telling you about the direction of travel?
So directionally, it tells me, again, that investors are yield hungry since we've seen the inflow into fixed income broadly, but then maybe some of the, let's call them riskier asset classes, like you mentioned, like CLOs and the growth of the space that we've seen there. So it's, again, it's broadly told me investors want yield. I would just, I guess, express a little bit of caution when chasing that yield. Again, given that spreads are at all-time tights, looking at the kind of consumer and consumer sentiment that I know you talked about previously on that show, growth in that space concerns me a bit more. So again, constructive on credit, investors want yield, but I think it's really important to exercise just caution on where you're choosing to invest.
To kind of harp on that point about consumer caution, Winnie, do you think investors are underestimating the state of the consumer right now? There has been a lot of talk about the bifurcation of the U.S. consumer, but people have kind of shrugged it off in a lot of ways in a lot of sectors. Do you think that can drift into more areas of consumer spending that could really hit the bond market for particular corporates?
I do think that there has been a lot of confusion around the state of the consumer. We've had consumer confidence numbers that have been quite negative for a persistent amount of time and then got a little bit better and now are trending lower again. But even as consumer confidence was pretty down and out back in 2022 as inflation was really peaking, we didn't see that consumer stress or strain that was consistent with kind of recession-like spending or a retrenchment to more cautious consumer behavior. And I think that more broadly, markets really underappreciated the amount of liquidity that had been injected into household balance sheets, into the global financial markets. And now we've had a few more years to kind of run through that liquidity. And I do think that there's going to be some shifting behavior from consumers that perhaps people are not necessarily appreciating because we've been looking at that consumer resilience and durability that was so evident for the past few years.
Ashley, if you think about the drivers of the bond market right now, you're talking about yield. People love the yield, fine. But the problem with the yield levels that we're at right now is if there's a drift higher. And with the uncertainty around the 10-year, and many investors still thinking you could see a 5% this year, do you think that there's a miscalculation on that ripple effect into corporate credit?
I don't think there's necessarily a miscalculation, but I do think it's important to point out something that you're alluding to, and that's the technicals in each market. And so for investment grade, I do think about the buyer base there and kind of who is that yield hungry investor. Broadly speaking, it's pensions, endowments, et cetera. That's the investor base on the institutional side that can potentially look through tighter spreads. Now, granted, yes, they want a spread pickup where they can get it, but they're investing to offset their liabilities, of course, over a 20, 30-year period. So there's technical support there for on U.S. investment grade. On the high yield side, a little bit of a different buyer base, less institutional, but there's some interesting supply and demand dynamics that are happening in that market. We've seen the growth of private credit as an example over the past 24 months or so, and that's siphoned off some of the supply that normally comes to market there. So that imbalance on the high yield side is providing some technical support as well. So in both markets, we do have this interesting technical support backdrop, despite, again, tight spreads or maybe some murkiness on the surface.
One can only hope the support sticks. Ashley Allen of JPMorgan Private Bank and Winnie Cisar of Creditsights, we thank you both for joining us this Friday in this very complicated market. Now, still ahead, the final spread the week ahead, and it features German elections, NVIDIA earnings, and U.S. PCE, you might remember as the Fed's favorite gauge of inflation. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for my final thought. A look at PCE data next Friday. And of course, the estimates core month over month expected to rise, while year over year forecasted to fall despite a hot inflation print. From New York, though, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.